Hello, friends. Today we are talking about Union Pacific Corporation, ticker symbol UNP. They reported last month on October 19. Analysts are saying that it's a buy. They're looking for a 12-month price of about $245, which will be an upside of almost 12%. They are 4% year to date. They were they were close to 200 not too long ago. So the question is it a buy? Um, at least for me. Once again, I am not a financial advisor. This is not financial advice. This is for educational purposes. I just want to um, take a look at Union Pacific to see if this will be another of the railroads that I would like to add to my portfolio. I own Canadian National and CSX. Um, and I'm looking for. I really like the railroads because they're kind of a monopoly. They own the railroads where that they service. So this is the map of Union Pacific, and as you can see, they own a really big part of United States. They're not only own the railroads, so that means if another company were to use them, they have to pay a fee. They also charge companies for the transportation of a lot of the products, especially over here from California, going all the way to the east of United States. Anything that comes to from China, it gets transported. In most of those cargo gets switched into a railroad to be transported into the mainline land, and they also own the cars, and they also rent those things for transportation. So they are they're a monopoly. They are create a lot of cash flow. They're a little down because um, as there is fears of recession. Whenever there's fear of recession, there is fears that the amount of products that are going to need to be shipped are going to go down. It's not just product like what we think about. It's also cars that get transported, grains that get transported, coal that is transported. So some of these companies are a little more susceptible to those things. Union Pacific it's a company that has been doing really good in the last 5 years. They have grown 45%. In So let's take a look at the last earnings. In the last earnings on October 19th, they beat earnings just by a little bit. They missed on revenue, but earnings per share, they beat. So that was pretty good. Um, Looking at the financials for the past 10 years, the revenue per share has going up steadily in the last 10 years, about 5.2%. In the last 5 years, 5.5. So it's really consistent, the amount that has been growing. When it comes to earnings, there are some nice spikes, but other than that, it's been going up kind of very steady. In the last 10 years, it has gone up 8%, and 5 years, once again, around a 5%. Profit margins. This is something that you will be seeing with railroad companies. They have high profit margins. In the last 5 years, the average is 27%. I think in this year to date, profit margin was 26%. So that's pretty nice. Um, when it comes to free cash flow, they are a money making machine most of the time. They do, once again, get hit whenever there is some kind of recession. But as you can see, they have been growing for the past 10 years, about 8%. And for the past 5 years, it's a little flat at 30%. But when it comes to free cash flow margins and average in the past 5 years, almost 24%. So that is amazing. That's a great great business model. Um, Book value per share, it remains flat. These companies, they do have a lot of assets, but they also do have a lot of liabilities. They take debt on to keep. There's a lot of capex, capital expenses on trying to maintain the machines and the railroads. So there's very capital intensive kind of business. So as you can see in the last 10 years, they're flat. 5 years, it has gone down a little bit. This also are numbers that are amazing. Return to equity in the last 5 years, average is 32%. And this is what I was going to look at. The last 3 years, if you see, is 44%, 57%. And this is the trailing 12. Sorry, it's not the last 2 years. So the trailing 12 is 49%. So that is just amazing numbers. Return to equity is 10%, and return of invested capital 15.3%. So it's just amazing numbers. When it comes to dividend, the dividend has been growing in a CAGR of the last 10 years of about 13%, which is crazy. If you are a dividend investor, this is the dream. This is kind of what you will love in a company. In the last 5 years, 11% growth. So that is awesome. I am more, I do like dividends. I like more value. I'm more of looking to grow equity. I'm not looking too much for income. Income is nice, but I'm looking more for undervalued companies so that I can grow my little retirement account. When it comes to debt, long-term debt, just like I mentioned, it continues to grow. That's how they pay for a lot of their capital expenses. If we were to take the free cash flow of the past 5 years average, and if we took all the long-term debt, which is 53 billions, divided by the 5-year average of free cash flow, it will take them about 6.5 years to pay. That's a little higher than what I like. I normally like a 5 to be able to pay it in 5. And as you can see, their debt has grown in the last 10 years, 20%, 18%, and in the last 5 years, almost 14%. Shares, they are good at buying back shares. They have been buying back some of the shares, and average very consistent in the last 10 years of 4.11, and in the last 5 years of 4.11. Analysts predict that they're going to be growing on about 6% a year. This normally has to do with earnings, but as you can see, in the last 5 years, revenue has grown 5.4%, earnings 5.6%, free cash flow 2.3%, book value has gone down 3.3%, and so for the average it will be at 3.25, but I'm going to be using a 6% for my future valuations that I'll be showing you. So if we were to look at the multiples valuation using the revenue per share, earnings per share, free cash flow per share, book value per share, and dividend, and using the trailing 12 months compared with the average of the last 5 years, multiply by the multiples average of the last 10 years, we're looking at a fair value somewhere between $193 to $175 conservatively. So remember, this is a very conservative kind of way of valuing. This is historically what it normally people has paid for this company. If we look at the payback time valuation, if we were to look at the average free cash flow per share of the 816, we grow it at 6% for the next 15 years, and we add them up, we will have received close to $210 And if we do discounted earnings valuation using the average, which is what I like to do, taking the average, no free cash flow, sorry, this is earnings per share of 932. You will see growing it at 6% for the next 5 years, and discounted it back, it will be $124 after we look at an average of 20 PE. And an owner's earnings valuation, we're looking at somewhere between the average of $170 for value to $186 trailing 12 months. So whenever we put everything together, we looked at a fair value is of somewhere around $185 if we use the trailing 12 months, or $172 if we look at only at the average, at the 5-year average. So somewhere between $180 will be the fair value. If we look at the price today, it's 119 as the moment that I'm recording. The thing about most of these companies, because they're a monopoly, they're normally overvalued. It's really hard to buy them undervalued. This is why I have not bought Union Pacific. It's just there's another couple of railroads that are more in a discount that I'm looking at, or that I own, which I already mentioned. But if you wanted to buy it right now, I think is at a 15%, nope, 20%, yes, 20% overvalue, somewhere around that. So that's my opinion. If you have any comments, please leave them down in the description. If you disagree with me and I'm missing something, please let me know. And also, please subscribe. It will really help the channel. Thank you very much, and thank you for all your encouragements. And I'm trying to get better at this. So have a nice one.